Hey, what's going on, guys? It's Jeff here back again with another video. Today, I think I want to talk a little bit more about inflation. I think because currently we are looking at a lot of data, especially from the CPI data that we have received over the months. And I think inflation is currently a very, very huge topic where the Feds are actually talking a lot more about it, especially. So I believe that this would be a good topic for us to actually talk about. Let's say you have a $20 note, and then poof, now it is a $10 note. We like to use fiat currency as one of the main currency for us to actually go through inflation or deflation. So I was brought up to think that inflation was something that only happened every single year, and we get a solid 2% or 1.8% a year, and it will just gradually go past, which is why we were taught to never leave our money in the banks and always put our money into use, be it a savings account that gives higher interest rate, or we do any sort of credit style investments, or even we can go down into actually doing, say, like investment in stocks, investment in crypto, investment in properties, investment in anything other than putting your money into the bank. That is how we actually do hedging for inflation. So, how do we actually get around inflation? So, I think that there are multiple ways for us to actually hedge inflation. So, back in the olden days, my parents, kind of olden, they would actually buy gold, something like this kind of thing, golden bracelet, golden necklaces, even golden coins or anything of that nature. They will buy gold to hedge against inflation. There might be possible spikes throughout this decade or two where gold might suddenly go up exponentially and possibly make back the profits and also hedge inflation in the process. So yeah, just for example's sake, this is a gold bracelet that my mom bought in 1995, which is a day before my birthday. She bought this for close to $200. So of course, I think that a lot of people already know that you can actually hedge inflation by buying into gold. But I feel that there are also various other methods that I want to bring up in this video for people who are actually interested into hedging inflation, or even just to find various investment methods that they can actually use to properly position themselves better against inflation. So let's take a look at investing into a company. And I do not want to use big companies because hindsight is 2020. I do not want to really take Amazon or Apple, simply because I feel that it would be unfair for someone to actually foresee the possible future where Amazon and Apple rule the world. So instead, I feel that I should take a company that a lot of people can actually relate to, where the growth isn't so explosive to the point where it seems unattainable. So let's take a look at a company I feel that we all know, which is McDonald's. So let's put this inflation to the test. If we were to invest into McDonald's back in 1995, instead of my mother actually buying this gold bracelet for almost $200, we are going to take into consideration that my mom actually took the $200 to buy into McDonald's at that time. So the average price of McDonald's in 1995 was about $16. And today, the price of McDonald's is at $238, nearing to 240. Also, let's not forget that there is also dividend that comes with investing into the said stocks. However, the dividend did not actually come in before 2005. So, like I said before, if we are actually using this gold bracelet, which is $200, we are actually going to be investing this $200 into McDonald's, which would get you 13 odd shares. So these 13 shares will be placed in the brokerage for the next 10 years. So let's go decade by decade. So in 2005, McDonald's shares was at $35. So at the same time, the gold prices actually went down simply because from the private debt and the gold bubble that was going on back in 2005, gold prices actually went down slightly. So the same $200 bracelet would actually be worth about $190. So let's fast forward another 10 more years. So in 2015, we saw McDonald's price go up all the way to $100 from $35 in the previous decade. This is almost triple the amount of growth from 2005 all the way to 2015. However, do remember that in between the 2005 to 2015 transition, there was multiple crises that actually happened. One that is more obvious than the others, which would definitely be the financial crisis. McDonald's still managed to almost triple their stock price in this timing. However, we do need to also take into consideration that gold did not really perform that badly either. The same gold bracelet would have fetched a price of around $420 in 2015, which essentially would be more than two times of what they actually did, which definitely is outperforming the previous decade. And since we do not have any information on 2025, as much as I wish I do have information on 2025, I feel that we can just do half a decade, which is 5 years into the future from 2015, which is 2020. And since 2020 is also quite a scarring year for a lot of people as well, especially in the economic sector, I feel that this would actually bring forth a even clearer picture of why I think that there are multiple ways that you can actually hedge against inflation, and also why it is so important for us to invest our money smart and safely. So in 2020, before the entire pandemic situation, McDonald's was peaking at about $218 and had a deep down, a pit at around $136. Whereas the gold bracelet that we actually talked about would have fetched us around $600 at the top and about $450 at the bottom. So, due to the nature of how stocks and commodity would work, I feel that this comparison wouldn't be exactly the most accurate. Gold actually thrived during crises, such as the financial crisis and even the pandemic. Gold prices actually spike up a lot when people actually were worried to put in their money into companies. So, just for the sake of comparison, I actually took the highest possible price that we can get for gold in 2020, which is $600. For this bracelet, we bought it in at $192 and we sold it at $600. And for the 13 shares of McDonald's that we actually bought it in when it was $16, we would have gotten 13 shares of McDonald's priced at $236.89 as of this recording, and we would have gotten $3,068. If we were to actually take the worst possible price to sell in 2020 for McDonald's shares, if we were to actually bought it back in 1995, the 13 odd shares to be sold at $136, we would have actually gotten it back for a valuation of $1,768 as compared to $600 for this bracelet at its peak, whereas the $1,768 would be at the worst possible timing to sell. That would kind of prove the point where why you would want to invest into stocks more than you would want to invest into commodities. However, I feel that this might not definitely be the case for all commodities, simply because we also do see the rise of copper, and we do see the rise of other different commodities, even such as cryptocurrency, which I personally treat as a sort of commodity slash token. Also, just to drive home the point about why you should invest in a company as well, for McDonald's, on top of the $1,768 that you actually get, let's not forget that out of the 25 years, about 15 years of them, you actually get dividend as well. And if I were to actually do an average out for the dividend, we are getting about 2% a year on the dividend as well. And for people who actually do not understand how big of a deal this is, do understand that McDonald's might seem like a very, very big company, but it is not even in the top 50 US largest market cap company as of now. And I believe that there will be some people who actually want to bring up the point of comparison to Bitcoin. But I feel that if I actually do a comparison with Bitcoin, I will just show you a picture of the moon. So I don't think that's going to be much of a comparison. And also for people who actually want to bring up a possible hedge against inflation using real estate, I feel that that would definitely be a valid point as well. But I feel that simply because we are using a $200 as a barrier of entry, I feel that it would be unfair for us to actually use real estate simply because the barrier of entry is way too high, especially in Singapore. I feel that for you to actually buy a house in Singapore, unlike in the States where you can get a house at, let's say, 30,000 $40,000, you couldn't even get to pay a down payment using $30,000 $40,000. So I think the argument for it would be slightly flawed. So I feel that real estate, maybe not. However, if you do want to bring up the argument by using REITs, then I would say yes, maybe. If you do want to do a sort of comparison for that, do leave it down in the comment section down below, and I might be able to do a little bit of comparison for you guys to actually see what is the ROI for REITs as compared to various stocks or cryptocurrencies or even gold and commodities in general. And of course, index funds. But I feel that index funds would be quite an obvious one simply because I feel that everyone knows that the index fund, you got your Dow Jones, you got your S&P, you got your Nasdaq, you got all these various index funds, even for the smaller countries such as in Singapore, or if in the bigger Asian countries such as in China, in Shanghai, where they have the Hang Seng Index. All of these index definitely will be able to allow you to hedge against inflation, but I feel that that would just be a very, very obvious way to hedge against inflation, and I don't think that would make much of a content. So now we have a rough understanding of how inflation actually work. So maybe we can talk a little bit more about inflation now. So how does inflation actually happen? So inflation basically stems from supply and demand. When a supply is way too high and the demand is way too low, deflation happens. And when a demand is way too high, when the supply is too low, inflation happens. So this is a very simple game of balance. However, I feel that a lot of people in the countries will not be able to actually find a nice balance between the supply and demand. There's way too many factors moving this scale of balance. So a lot of people actually assume that inflation comes every single year. As true as it is, but the thing is that we do have multiple reports, such as the CPI data, which is the Consumer Price Index. We also have the PCE reports, which is the Personal Consumption Expenditure. And we also have the PPI report, which is the Producer Price Index. So these are the various data that is actually given by the country every single month to actually show us what are the different items that consumers are actually buying and the prices of those items that are actually being bought. Similar with the producer price index and also with the PCE, there are various data to actually show us that what are the items that prices are actually rising for people to understand what are the things that will have a proper trend for it to actually go up over time. So in CPI reports, we actually get various prices such as the coffee prices, the rice, the food, we got gasoline, we got energy, even transportation prices as well. So when we do see a huge increase on these prices month over month, it simply means that it would eventually trend towards a very high CPI data, which also equates to a inflation data over time when we do it out in a year over year index. So the main question is, how do we actually go about getting rid of this inflation eventually? So I understand that because that inflation currently happening is not really the biggest concern to a lot of people simply because we're still currently in a pandemic. So it might not seem like the biggest issue at the moment. However, I feel that inflation would come back to bite us in the ass if we do not fix it as soon as we can. As much as I do not live in the States, I feel that it would gradually have a residual impact down to the other countries, especially for a small country that we are in. I feel that we will definitely get impacted by the various data that actually happen in the States. So a lot of money have actually been getting into the economy due to the various stimulus check that is actually given out by various governments from different countries, in hopes that all this money would eventually be put back into the system, hence stimulating the economy, hoping that people will spend more money, and eventually this money will then go to the taxes and then back into the government, hoping that this would just give a small boost to the economy, hoping that it will just go for a further way. However, let's just imagine that if only 1/10 of the people who actually got their stimulus check actually use the money to buy things in the economy, such as buying food and buying more things that are not necessities, such as maybe a Peloton running machine, or even if they want to buy a painting, or they want to just spend the money in hopes that it would help with the economy, and only 1/10 of the people are willing to do so, while the other 9 out of 10 people are willing to just put their money in the bank and just get a 0.05% interest over the year, and they feel that they should not be spending the money during this period of time. If this actually happens, businesses would have lesser sales, and in return, they will have to pay lesser in tax. And for government, they would have essentially just given out the money with no return strategies back into the feds, where the money just goes to a dead end and it helps nobody. So, for people who actually think that this actually doesn't really affect them, the huge issue that I can actually see coming would be that small businesses actually get affected by the people who are not willing to spend this money during this period of time. Because for small businesses, once they do not have enough business and they actually have too much of an expenditure where their income doesn't really cover the expenditure, eventually the small business would have to close down, and the bigger companies such as your Amazon or the Apple will come in and just monopolize every single thing, just like how Apple has already monopolized the entire online technology side of things, while Amazon have kind of monopolized everything that you have to do with e-commerce. So of course, I feel that there's also a possible argument where people might think that you are working in a big company, so it wouldn't really affect you. So let's just bring this even further in just a little bit. So for big companies, they would have to expand when all these small businesses eventually die out. So let's just imagine in a country where you have, say, 2,000 small businesses and you have about two big companies that actually can are able to do everything these 2,000 small companies are able to do. These 2,000 companies will eventually dwindle downwards to about 200 companies, and then the two giants will be able to take up the rest of the 1,800 small companies job scope and still let the economy continuously move as it is. So you might think that there's still nothing wrong with it. That is true. But the thing is that you have to also take into consideration that when these giants actually have to expand, they'll now have to take into consideration of various factors when they want to expand, such as the material cost, the labor cost, the land cost, and let's not forget the tax as well. So when these four factors that actually weigh down on all these business owners, especially the big companies, this might become a bigger issue. So, for example, we actually take into consideration that this might be an American business, a business that is based in America. They'll eventually have to move their entire operation to another country. So, for example, if they were to move their entire operation to a cheaper country, first of all, the people in America would have lost their jobs because let's say about half of them do not want to move to another country just to do operation costs, and because of that they kind of lose, say, half of the working force in America. And let's not forget, because the thing is that Americans might also be a lot more expensive as compared to a developing country's labor. And let's not forget as well, because this would actually stem into a even more serious issue where Now the company would actually be based in another country. They might be able to move their entire company operation over to the other country and actually work by that country's tax law instead of where they are actually from. So now, if this company has moved over to another country to get cheaper labor, cheaper materials, cheaper landscape, and also cheaper tax, chances are they're just going to grow their entire brand in America, where they actually get so much brand reputation, and eventually they can just move to another country and they can still continue their operation without much hassle. And also, if you think that that is also the end of the consequences, do you remember when I actually told you guys about how the workers might actually now, the Americans might now be jobless due to this entire operation moving to another country? Yeah, well, now those workers will not have a steady paycheck, and now they will not be able to spend the money in the country, stimulating the economy that way. And from that entire issue, it will then create a spiral effect where we will actually all go down, where the country will just lose a lot of resources for no reason. But at the same time, if you are someone who actually care about the world as a whole, it kind of helps out because a developing country did gain a giant conglomerate business, and it will probably help with the GDP over time, I guess. Okay, so if you're still listening now, I just want to thank you guys for really hanging on to this video, because it is been quite a period of time. I have not really done the editing, but I'm guessing this is about already about a 10 to 20 minute video as it is. So I would really appreciate it if you guys can just help me tap the like button down below and maybe just grab a cup of coffee or something. Let me just get a little bit of drink. All right, so now that we are back, so how can we actually help to prevent this entire scenario from actually happening? Firstly, you can actually help by actually helping to spend some money into the economies, by helping to support local businesses, small businesses especially, so that they would continuously get more sales and eventually grow slightly bigger, but at a very reasonable pace, in order to create competition for the bigger companies. As much as this might sound crazy, you should not be saving money as of now, simply because during this pandemic, if you are actually saving money, it would be very, very brutal for the economy as a whole. So I feel that it would be better for you guys to actually spend some money, support the local businesses, especially the small businesses, because that way they would actually get a little bit more margin over the bigger companies, and that way it would grow to become a more competitive space over time. But for someone who actually do not know much about the industry or the markets, but I'm someone who is a little bit obsessed with numbers and the data, and I feel that this entire journey doing this market watch thing is actually kind of fun for me. However, for people like me who are still new to this market, when we look at the index, such as the Dow Jones or the S&P, we would not really understand the real problem in inflation or in the economy, due to the fact that we are constantly hitting new highs every single day or every single week. So for people like us, we might actually think that, maybe US is not really suffering from a pandemic, and instead they are actually thriving from a pandemic due to all these record highs every single week. So what's the problem if the Dow Jones and the S&P are constantly getting record high every single week? It simply means that people like myself, we are all putting our money into the stocks market as much as we can, hoping that the market actually grow and the economy eventually prosper. Because the thing is that when we actually invest our monies into companies, growth companies and technology companies, so for example, if I were to actually put, let's say, 20% of my entire savings into Apple, and over time I would have gained a little bit of money back, hopefully I will take the money to actually spend it into the economy, hoping for a return of money in the future. So for people who actually keep on putting money into the stocks market, such as myself, it is actually very normal for us to take the stimulus check and just invest into the market, especially with how investing has been made so viable and so accessible by people of all ages. I feel that there is a very high possibility that people are actually investing more vigorously than before, and people are a lot more fearless than before when it comes to investing, especially with money that is coming from the government as a stimulus check. Even if you were to just invest and lose it all, it doesn't really affect you simply because it wasn't really money that you earn. And at the end of the day, the money goes back to the economy. Nobody actually loses. So I feel that at the same time, when the index is continuously spiking and peaking at every single corner, it might sound like a very, very good thing, but I feel that we are not exactly out of the woods yet. But of course, I do not want to be the person who rain on the parade simply because I myself is also heavily invested into the stocks market as well. And trust me, a crash is literally the last thing I want right now. However, if hypothetically, if there were to be a crash in the market, let's say something along the side of the 2008 financial crisis, there'll definitely be a lot of mayhem in the economic world. But I feel that this would actually help the newer investors, such as myself, to actually relate to the losses that we can actually lose from investing into the stocks market recklessly. And I feel that this might actually create some sort of a cyclical effect. I feel the people of the older generation are actually a lot more risk adverse when it comes to investing as well. So I feel that it is also possibly because they actually went through the 2008 financial crisis and they actually know what to expect. For people like us, where we are so risky in all our investment, some people actually put in 95% of their entire savings into the stocks market, hoping to double it in next year. So I feel that maybe a crash is what is needed for people to actually understand the risk that actually comes with investing in the stocks market. I feel that that is also one of the reasons why my parents are still doing a 0.8% per year interest or a 1% per year interest with the banks on all their money, hoping that they just get their safe investment and the safe ROI back. Whereas people my age, we want to take more risks because we are still young. And honestly speaking, I definitely stand behind that simply because I did make a lot of my money from investing, and I feel that this is actually very, very important for us to take risks early because we do not have a family, nor do we need to pay off a house. We do not have a lot of baggage with us. And I feel that that would be the best time for us to actually take risk. And of course, I do say risk a lot, but risk might sound fun. And people who are just getting into the market, hoping to get a fast profit every single trade, I just hope that you guys do be careful because the thing is that me personally, I am actually doing day trading. I am kind of doing the same thing as well, where I'm doing high risk and sort of medium reward. I feel that this is considered quite risky. But the thing is that because ultimately I did start out with about $1,500. So right now I'm kind of just playing with house money and I just want to see where this goes. But most importantly, for people who actually got into the stocks market for the fast profit games, for people who actually got in, especially during the GameStop saga, the AMC saga, and all these different momentum stocks rally. And if they actually comes out losing their money, I hope that they do not lose the faith in investing overall. Which is why I'm actually here, hoping to educate people, my generation, into investing and to let them see what is the good part of investing and also to try to stay away from the more dangerous parts. And if they do want to partake in all this dangerous or risky investment, they can do so, just do it safely. And of course, I do want to add this at the end as well, which is very, very important, which is I do not have any financial degree or any economics degree or even a degree at all. I don't even have a degree. I just like the number and I read the news a lot and I like to share what I know and hopefully someone would get value out of what I took in. So yeah, so if I do have any incorrect information, please leave it down in the comment section down below because the thing is that I might actually have some false information or incorrect information. However, all this information are things that I've actually researched into, and I'm not sure if it's right or wrong, but I did try to cross reference most of my information. So I hope that if you guys do have any questions or any problem with any of the information that I actually gave out during this entire video, please leave it down in the comment section below, or even just DM me over at my Instagram at this handle, and that way maybe I will be able to improve for my future videos. And with that, I thank you guys for staying all the way to the end of this video. I understand that this is quite a long video, but I personally really enjoy talking about inflation. And even then, for this entire topic, I feel that it's still not enough, and I have not even given you guys the bulk of the information. I feel that this is quite the surface level information that you can actually find anywhere, and things that you can actually understand from logic alone. So I feel that hopefully, if you guys are really interested in this kind of content, just subscribe to my channel and follow me over at Instagram, because I do post markets update every single trading day. And as always, I appreciate all the comments and all the likes. And with that, Jeff out.